You know, look, I think about the markets moving after the election and about what people thought was going to happen and not happen on legislation is dramatically overblown. I think that a lot of the market movement and what you saw was just a view that maybe the tone and the nature of business in Washington was going to change a little bit, and it wasn't going to be so much, you know, we're out to get you. And I don't want to overstate that. I don't want to be partisan here because I'm not a partisan person. But I do think that the tone in Washington has changed dramatically towards business and toward people who are creating jobs and putting capital at risk and so forth. And it's more of a, how can we help you do that? How can we help economic growth? How can we help jobs? And so more so, in my view, than, oh, gee, when is tax reform going to pass? How much is my tax going to be cut? What about Dodd-Frank? Are we going to get rid of these onerous regulations? Or are we going to have a big infrastructure spending bill? You know, those are very, very important, but I do think that overriding all of this is the general tone that that's associated with what's going on here in Washington vis-a-vis the administration and business. And that's setting aside any personal viewpoints that I have or anybody in the audience has about individual things that are tweeted or are commented on or anything like that. But so first of all, I think that drove the market a lot. As far as things getting done this year, look, I don't think there was ever much of a realistic expectation on the people who were commenting on what was going to be done in the first 100 days. Tax reform in 1986 took about 3 or 4 years to get to where it was. And it wasn't just leadership by the president or anything like that. It was trust between Republicans and Democrats. It was trust between the House and the Senate. It was trust between Congress and the White House. And that trust was built up from 1982 to 1986. They did 8 or 10 tax bills during that time period, which created trust. We haven't had a tax bill in this town in a long time. We haven't had any legislation in a long time. So there isn't that trust. So the expectation, those of us who do this for a living, and you all do whatever you do for a living, and you see these, whatever it is, predictions in the press or somewhere, and you go, that can't possibly happen, because you know what you're doing. And when I saw these predictions, I said, that can't possibly happen because I know what I'm doing. And so it takes time for any of these things to occur. And I wouldn't necessarily have a scorecard, particularly on this administration, on what they've done in the first 100 days, because part of what they're trying to do is undo things. And so, you know, it's really an interesting game that's being played out there now about, is it a successful 100 days or an unsuccessful 100 days? I don't know. Let's wait and see, and let's let this stuff play out. You know, having said that, and some people here, some friends are here in the audience, and they know I'm a baseball fan, a baseball player. I love baseball. And Washington is sort of like Major League Baseball was in the late or early 1920s. And before 1920, it was a dead ball era. Everybody was hitting singles and bunts and doing nothing, you know, 1-2 to nothing games. Along comes Babe Ruth in 1920 and hits 54 home runs, and pretty soon everybody's swinging for the fence. Now everybody in Washington is swinging for the fence. And just like back then, not every ball went over the fence. Not all these proposals are going to go over the fence, but there's a lot of activity going on, and whether it's on tax reform, infrastructure, Dodd-Frank, regulatory review, all kinds of things. So there's tremendous amounts of activity. There's a lot of people swinging for the fence. Is it going to get done this year? You know, I'm a little doubtful, but I'm doubtful not necessarily because somebody's going to fail. I'm doubtful just because these are enormous questions. And I think that they learned a lot, and I'll stop because I know I'm going too long, but I think they learned a lot from the healthcare situation where, you know, a small group of people talked to themselves for a long period of time and then came out and said, okay, let's pass this. And they never really had hearings. They never involved a diverse viewpoint to vet things, and it got shot down. And they set artificial barriers. We're going to pass this by, you know, March 1st or whatever it was. So I think they've learned from that now as you go forward on tax reform, infrastructure, and these other issues. And I think they're going to be much more deliberate. I think that they will think things through a little more carefully, not set artificial deadlines. Whether they get it done this year or not, or next year, who really cares as long as they get it done right. For this industry, we've got a lot at stake, a lot of opportunities and a lot of risk. And I'm happy to be here because everybody should be paying very, very close attention to what's happening here.
So that's a perfect segue. So I'm going to go one more to you before we get these other guys involved. So the House Blueprint has two concepts that obviously impact real estate meaningfully. The immediate expensing of investments and the elimination of the interest deduction tax rather than a personal residence. So are those proposals positive or negative for real estate, and how do the various parties
depends on where you sit in the transaction, doesn't it, boys? You know, well, first of all, they're very serious. And I'm not sure everyone really heard what you said because it is such a dramatic change in the way that people think. I've been doing this for 35 plus years. On behalf of real estate, if I would have gone up to Capitol Hill 2, 3, 5, 10 years ago and said, hey, let's expense buildings. Let's, in other words, take all of the cost and write it off in the year that we make the investment, people would have laughed me off the hill. Are you kidding me? You're not going to expense a building. But that's what the proposal is up there now, to expense all investments, not depreciate them, expense them, not deduct the interest on the debt used to acquire that asset. Is that good for real estate or bad for real estate? It does depend on where you're sitting. I think that, you know, on a going forward basis, new investment, you might say, well, it's pretty much a wash. Who really cares? It's okay. And that is sort of largely true. It's a pretty even trade-off in most situations. But we have $17 trillion. You guys own a bunch of it, so you know $17 trillion or so of commercial real estate in the United States. It is capitalized by debt and equity that were put in place under a set of rules that Congress told them to do it. Depreciate a building over 39 years, depreciate a multifamily structure over 27 and a half, deduct the interest on the debt. Those are the rules. Now along comes a new set of rules. You know, as I said, it might be okay for new people, new deals, but what about that $17 trillion of invested capital in real estate? And that creates real concern to us. And it makes us want to think about, you know, what's this mean not only for individual investors in real estate, but what's it mean for local markets, what's it mean for lenders, what's it mean for people who invest their pensions into real estate. So this is big, big stuff, and I'll stop by saying this $17 trillion is roughly the equivalent size of the New York Stock Exchange. Now, no one would suggest that we're going to take the New York Stock Exchange and suddenly close it and have that $17 trillion of capital and not know where it's going. So this is big stuff, and I guess the other thing that I would just say, and I really am taking a long time, but these are proposals that are offered in a spirit of helping the economy, helping economic growth, helping jobs. And so we're trying to look at them in that spirit. And there's other things, denial of 1031 treatment, a new category for income on partnership income and so forth, taxation of partnership income. All kinds of issues, and you have to look at the whole thing. You can't just sit there and say, well, we're going to lose interest deduction. Oh my God, the sky is falling, because there's all this other stuff. So it's almost a full-time job right now, and it's a lot of fun.
Love it, love it. Can you talk specifically about the infrastructure bill, both in terms of scale and in terms of timing?
Sure. By the way, if they do away with the deduction for interest on debt, the debt's going to go up in price, right? So the values are going to come down. On your comment, Len, about banks and Basel III and the limitations they're having on construction lending, that is true. It's not Dodd-Frank. It's Basel III, and it's some of these other things that are layered. There's a whole bunch of them that are layered on top of each other that are impeding a lot of community banks and a lot of development and acquisition lending. But there is legislation that wants to correct that on Basel III, and it actually has legs, by the way, outside of Dodd-Frank.
For smaller banks or all banks?
For smaller banks.
Yeah, right, only for regional.
Yeah.
banks,
So what's that? Infrastructure. I think, there again, look, people, they have in their head, oh, we're going to spend $1 trillion and rebuild every road in America. And I think that reality is set in a lot on this. And I think, first of all, the infrastructure bill might focus, on the permitting process. Look, the permitting to do any of these infrastructure projects across America is so strenuous and so inefficient and so time-consuming and so costly that if you could somehow streamline this stuff so that there wasn't 10 or 12 agencies overlapping each other, building on, again, multiplicity of time and effort and energy and cost and lawyers' fees and blah, 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 that would bring some of the cost down from this $1 trillion that everybody talks about. So I think the first thing when you see an infrastructure bill, I would think that this permitting, streamlining permitting, getting a more general agency that can oversee people. This occurs now in some of the Endangered Species Act stuff that goes on, where you used to have layer upon layer of bureaucracy overseeing things, and they sort of got it together a little bit in that area, and I think you're going to see some of that from the administration, that they'll try to do that. And why not? Because the infrastructure advisory group is headed by 2 real estate developers, big real estate owners, big real estate developers, and they know what it takes to get a big project permitted and from start to finish through. So I think they're bringing that mindset to this discussion and saying, wait a minute, we can do a lot by streamlining things. And then they got to find a little bit of cash here, don't they? Because you have to have some money to do things. The highways and infrastructure have always been funded by the gas tax. The gas tax has not been raised since 1992, I think. So, they could raise the gas tax a little, but they're not going to raise it that much to get $1 trillion. So where's the money going to come from? Well, they could, encourage some of this cash that you hear about corporations. Corporate America has, I don't even know what the number is now. It's a huge number, maybe $2 trillion, something like that, parked overseas where they're not bringing it back to the United States, because if they bring it back, they'll be taxed here. And so they have it over there. And the idea is to allow them to repatriate that money at a very low tax rate, maybe 5 or 10%, and take that tax money and capitalize an infrastructure bank, and then lever up the infrastructure bank from that tax money, and then you have some real money that you can start spending. So I'd look at permitting, I'd look at this repatriation infrastructure bank idea, and then the final thing that is really, really important and valuable for people in this room, I think, is where do public-private partnerships fit in all of this, and how can, there's a lot of capital, right? A lot of capital that wants to play if they can figure out how to get a return on their investment. Some infrastructure projects don't provide, much of a return, but a lot of it does. And if you can have a revenue source from an infrastructure bank to then go and help public-private partnerships come together, you can do a lot of things in there. So, I guess I would say the 3 main components would be, this permitting, streamlining, public-private partnerships, capitalize an infrastructure bank of some way, shape, or form. And, the bottom line is there's got to be some overriding czar or something like that sorts through all of these needs out there and decides what's spent if we do go down this road of an infrastructure bill. It's going to run into a lot of problems because, well, I'll just leave it at that, a lot of problems. How about that? Yeah.
So
nothing's easy,
This whole streamlining process, it would strike me as virtually impossible. I mean, do you think there's any validity to that actually happening?
I do. Oh, yeah, I definitely do, particularly with the mindset. A lot of this permitting and for national projects, big projects, these are national federal agencies. Everybody's got to have a piece of the action. The EPA, you go on and on, DOT, and all of these people have a little piece of action. So you have to get approval there, then you go there, and you have to do something different. So I think that with the mindset coming from above, and arguably the above, in this case, has experience in doing large development projects, and they're going to get advice from people like that. So I do think that there's going to be a strong movement there. Now, the system's not going to like it. The system doesn't like it. The system wants to keep their little action and keep their piece of pie, and I want to be able to approve, that. And what about the impact on this fly and that, whatever it is. And so the system doesn't like it. But if the direction from above, and in any of your businesses, if you guys direct things to happen, sooner or later the culture is going to allow that to happen. And as I said, there is some precedent for, for this kind of thing. And by the way, we've seen it a little bit here locally when the Wilson Bridge was done, when it took a while, obviously, but we had 3 jurisdictions. Everybody had to have their piece of the pie, and everybody had to feel like they weren't getting paying too much or what have you. And so Virginia, Maryland, and D.C. had to get together, and it's the same thing when you look at these agencies. So I don't think it's all that outrageous to suggest that we can streamline this review process, we can make it simpler, we can make it quicker. The president held up a chart the other day at the White House that he had a guy hold it up and drop down to the floor, and they said for a typical highway project, it took 12 years to get it approved. Now, come on. That's a little bit crazy, right? So, and 12 years would increase the cost. It would, all of these things. So, I don't think it's crazy to do this. And the chairman of the House Transportation Committee, who has a lot more say in this than I do, doesn't think it's crazy either.
So Len, let's go back to you. So call it 3 minutes. And my last question is of you to the students. So we have a meaningful student component in here. So what is the one thing you wish somebody would have told you at 21 years old that took way too long to figure out or cost you a lot of time and money? Jeff?
I don't know. Buy Host stock.
Or Apple stock.
I guess I'm not really sure. I mean, I had some very, very good advice when I was that age, which was basically, you can do anything you want to do, just show up, work hard, pay attention, and try hard, be honest. And to me, that's really the component in whether you're in my business or your business or whatever business it is. So I'm not looking back and saying somebody should have, gosh, I wish somebody would have told me that. Well, I do have one thing, because
By the way, I did say we had 2 minutes, right?
when I was growing up, I thought it was very, very important that you had hair. And I've come to learn that it's not all that important.